So we've got a big list of people. So David, I'm going to attribute this to your dashing, handsome, good looks, or is it the content? What do you think?
I think it's probably content. I'm going to
The
go with
content.
content. Yeah.
Okay, let's go with the content then. A lot of people interested in this subject. Franchise tax board. I don't even like to hear that.
I think the franchise tax board has a reputation, whether it's deserved or not, for being, kind of aggressive. I mean, California is a high tax state.
Sure.
So that's, it comes up sometimes as a dirty word, but it's something that I deal with pretty often in my practice.
You've learned to become immune to it, I guess, in a sense, right?
A little bit, yeah. Maybe you develop a skin,
Absolutely. Okay, well, let's get started. So, David, thank you so much for joining me today. For everybody on the call, I'm here with David Bellumori, corporate and tax attorney. Before we get into the content, because we've got a lot of great information here, we'll just go through a couple of housekeeping items. This broadcast will be recorded. So if we jump through the items quickly, and there's probably going to be a lot of information here, it will be recorded. If you'd like a copy of the recording, whether it's for yourself to watch again or you send to somebody who you think would need this information, you can email us at info@leavingthebayarea.com. My name is Scott Fuller. I'm the founder of leavingthebayarea.com and leavingsocal.com. We help people throughout the state relocate elsewhere. Sometimes they're staying in the state, sometimes they're going out of state. We provide full service relocation solutions for our clients. We will take questions. So if you have questions, there should be a little chat box in there, a question, Q&A box. If you have questions, put them in there. We'll answer those as quickly as we can as we go through the content. And last and probably most importantly, I have to put out the disclaimer for both David and myself. This should not be construed as legal or tax advice. This is information only. If you have specific scenarios that you need to get more information on, people like David are who you're going to talk to answer those questions on a one-on-one basis. So, again, we're going to give you as much information as we can. It's probably going to be more high level, but we want to make sure that, not legal, not tax advice, just great information. But when you need that information, you'll contact somebody like David. So, David, give me a couple of minutes of background of yourself, what you do, how you help your clients, and your firm.
Sure. Thanks, Scott. So, Scott, as Scott said, I'm a tax and corporate attorney at a law firm in San Jose called Berliner Cohen. I help clients plan and implement a variety of tax advantage structures or transactions. This includes advising clients on matters, such as qualified small business stock eligibility, 1031 exchanges, FBAR and FATCA related compliance issues, M&A transactions, and residency planning. I also routinely handle certain types of tax controversy work, which includes representing taxpayers before the IRS, Franchise Tax Board, and other governmental agencies. Could be the Board of Equalization, the CDTFA, the California Department of Tax and Fee Administration, IRS Appeals, U.S. Tax Court, those sort of things. The firm that I'm a part of, Berliner Cohen, is a full service business law firm, which in addition to the tax and corporate department that I'm a part of, also has a commercial real estate group, land use, employment, general business litigation, and estate planning departments. So we kind of run the spectrum of business services, and really the only things we don't sort of handle would be bankruptcy work and personal injury work.
Okay.
Yeah.
So you guys do, like you said, a full spectrum. You provide a lot of services.
Mm-hmm.
For purposes of what we're going to be talking about today, the terms residency audit stands out. That might be a new term to a lot of people, something you probably didn't think you had to think about. And so David, let's start there. What is residency planning?
Sure. So, so what residency planning is to me, or what that term means to me, is essentially, it involves advising a client who is looking to move out of California, or who's previously moved out of California, about their potential continued classification as a resident by the Franchise Tax Board in the event of a residency audit. And now I think a lot of people are, probably familiar with the general kind of, an audit, whether that's an audit of your business or your personal income tax return. But a residency audit's kind of a different creature and a different animal. And the reason that they're really sort of different things is that usually the subject of a regular audit, whether it's a business or an individual income tax return, it's about kind of the things you'd expect. Did you report your income correctly? Was there underreporting of income? Did you claim your deductions correctly? Were there, is there substantiation and support for the expenses that you're claiming or losses that you're claiming? Do you have the records to support, charitable gifts that you've made? And so it's a lot, usually a lot of kind of general audits are handled by, a CPA or an accountant, or the taxpayer themselves, and it can just be a matter of providing records. Sometimes it's more complicated than that, but oftentimes that's what I think people think of with an audit.
Yeah.
A residency audit, kind of by contrast, is much more focused on you as, you, the taxpayer, as an individual. And it's focused on things like, where you are on a day-to-day basis. What your, in a nutshell, what your connections are to California. And so I think a residency audit can be a lot more personal and potentially, intrusive, I think, in the minds of, the taxpayer who's going through it, than your kind of mainstream audit of a business. And with a residency audit, I mean, I guess to sort of step back a little bit, California has a fairly, I would say, complex set of laws and regulations that govern, when somebody is considered to be a resident for tax purposes. And there's sort of two, I think, related concepts here. There's the concept of residency, and sort of there's also the as part of that, the concept of domicile. And for the most part, I would say that all of the residency audits that I see are primarily questions of whether somebody is or continues to be domiciled in California. And now, so the distinction between those things is, is sort of subtle but important. And the term, maybe just to kind of give you an idea, the term, residence, basically it denotes any factual place of abode of some permanency. And so you can have, a taxpayer can have more than one residence, for tax purposes. And so a person can be a resident of multiple states through the year. You think about like snowbirds, things like that. But a domicile denotes sort of, one location that the person has your most settled and permanent connections to, and where you intend to remain. And so if you think about it as sort of like, gravity, for example, the domicile is sort of where your center of gravity is. It's where does everything sort of, kind of orbit around. And another way to think about it is that it's the place that you've sort of voluntarily fixed yourself and your affairs, and it's the place of your kind of permanent habitation, and it's the place where you have the intention of remaining even when you leave from there. So, for purposes of, I think, what we're kind of talking about in terms of residency planning and the types of residency audits that I see, the primary question, or substantial kind of question, usually the first question, is really about domicile. And the thing with domicile that I think is important in terms of this conversation is that once you have established your domicile, it's considered to remain established until you kind of, through your actions, demonstrate your intention to change that domicile. So give you an example. Let's say you have somebody who's been a California resident for a long time, decades, and they decide they're going to leave California. They're going to move to another state, and they take their possessions and they put them in storage, and they decide, they're going to move to Nevada, let's say, but they decide that before they're going to leave, or before they move to Nevada, they're going to travel. They're going to spend 6 months traveling around the world, or, around the US. It doesn't really matter. The key thing there is that individual may have sort of the subjective intent that, hey, I'm leaving California, I'm moving to Nevada. Mm-hmm. But the fact that they are then spending the next 6 months traveling around, they haven't necessarily, in kind of, the FTB's view, clearly established that they have relinquished their California domicile, because they have not really established a domicile in Nevada yet. So for purposes of kind of residency audit, that person might be considered to remain a California, a resident for tax purposes of California, because they have not clearly relinquished that California domicile. And so I think it's it's an important topic to kind of give some background on, because in a lot of cases, states view residency and domicile as almost interchangeable. California, I think, is much more nuanced and considered in how they look at those two terms. So yeah, and I think, as I said, probably the most important thing to keep in mind here is that your domicile, not only, does it remain until you clearly establish that it's been changed, but, you as the taxpayer, you have the burden of proof of demonstrating that that's been changed. And I find that often that taxpayers' clients can be confused on that subject, and they will, sort of say, well, let the FTB prove that I'm a California resident, and that's actually not the way it works. It's your obligation as a taxpayer to prove to the FTB that you are no longer a California resident.
You almost always have to be defensive, or just anticipating what could happen, and you've got to be the one to provide the proof. So David, we talked about kind of general audits, and I think when anybody hears the term audit, you just immediately get nervous, right? But now we're talking about residency audits. There's going to be a lot of people on this broadcast who either have left California or are in the process of planning to leave California. Everybody's going to have some sort of a concern, right? Am I at risk, we'll call it, for being pursued by the Franchise Tax Board under the terms that you're talking about? Mm-hmm. This might, is there a broad categorization of saying, here's select people that should be concerned about and should plan with residency planning, and then here's some very cut and dry, scenarios where you probably don't need residency planning because the odds of having a residency audit, we'll call it, are relatively low?
Yeah, I think there are, Scott. And I think, there's two situations that kind of generally will pique the FTB's interest. The first situation is, where a taxpayer moves to a state with a low or no personal income tax. So think, moves to Nevada versus moving to, New York. Mm-hmm. And two, the second situation would be, where a taxpayer moves out of California shortly before kind of a large income realization event, such as a sale of a business or of a substantial stock position. And so from those two categories, I think there's two elements you can sort of tease out of there. The first is that, if you are moving from California to a low or no tax jurisdiction, and if there is a significant income event relatively shortly in time after that move out of California, both of those things may be of interest to the Franchise Tax Board. And I think, I think also important to keep in mind here is that, I think it's rare for a residency audit to be triggered just randomly. A residency audit is oftentimes the result of something inadvertent that is triggering the audit. So, for example, I had a client where they filed a non-resident return. They had moved out of California, filed a non-resident return, but inadvertently, the accountants, when they prepared the federal return, continued to use the former California address on that return. And what happens in that situation is if you put, for example, your residence as your home address as a California, address on your federal return, the IRS forwards a copy of that return to the state Department of Revenue. So in this case, to the Franchise Tax Board. And what'll happen is the Franchise Tax Board gets, a federal return. And then they also get maybe a non-resident return or no state return. And they sort of look at it and they say, well, wait a minute, why are you putting a California address on this if you're not a California resident?
Yeah.
And that may be the first sort of thing that, the first sort of piece of information that may lead to, an interest by the Franchise Tax Board. The same thing goes for other types of information reporting. If you've got a K-1 or a W-2 or 1099, 1098, those sort of documents, if those inadvertently have a California address on them, copies may end up in the hands of the Franchise Tax Board, and the Franchise Tax Board is going to look and see, well, there's no tax return on file. Why are we getting a 1099 or an information return from somebody, some third party, with the California address, but there's no California return? So often a residency audit arises through some sort of inadvertent situation like that.
So David, if I can interrupt just real quick, because you mentioned something about a stock, stock liquidity or some sort of event like that. We have a question from Edward that relates to that. If stock options from an employer are awarded and vested in California, but exercised and sold after residency has been successfully reestablished in another state, does California try and go after that income/capital gain?
Yeah, I think the answer in general to that is yes. And I've had clients that are in basically that situation. And I think, without going into too much kind of detail on, that, because I think it's sort of it's a similar issue. It's not exactly, it's not a question of domicile or residency. It's kind of a question of sourcing of that income and where was that income earned. But just to say, I think an important element in situations like that is for taxpayers to have good records. And that applies not only to that situation, but it also really applies to residency audits. Because I can give you a quick example of a client I had that had a situation like that. And long story short, the Franchise Tax Board picked up that there were options that were granted and vested while the taxpayer was a resident of California. They sold them after they left California, and the FTB took the position that, look, these were essentially earned as compensation, or given as part of your compensation while you were a California resident. They are properly, a part of these are properly sourced to California, and the FTB took the position that we're going to count basically the number of days you're in California versus the total number of days that they vested over. And we're going to use that fraction as, how much is sourced to California and properly taxed in California. And fortunately for my taxpayer in that case, they had extremely good records of where they were, because part of their job involved a lot of travel. And so they were they were working in tech. And so some days they were here, Some days they were up in Washington, other days, they were in other states or other countries. And probably on average, they were spending 3 to 4 days a week outside of California. And because of the quality of their records, and we could show their flight logs and their entry and exit visas to various countries, we were able to kind of change that fraction, the numerator of that fraction, and really cut down the number of days where they were in California. And that had a really positive impact in terms of how much of that income was ultimately sourced to California. But that was because of the quality of the records that taxpayer had.
Okay, so prepare, plan, everything else like that.
Exactly.
I want to talk, you've mentioned a few red flags for the Franchise Tax Board, but before we get into that, in your opinion, how aggressive is the Franchise Tax Board right now with the number of people who are leaving California? Look, they're losing a lot of money, a lot of revenue. They're trying to collect as much as they can. How aggressive and how much has that changed over the last, let's say 3 to 5 years?
Yeah, so I think that's a good question, Scott, and I think it's a really timely question, in part because of where we are, where we all are right now in terms of kind of COVID-19 and the effects that has had on the projected budget surplus or deficit that the state had, and I think I think the FTB is known to be fairly aggressive with respect to residency audits because it is a high tax state, and there's a lot of people with a lot of wealth, and it's a clear revenue generator for the state. And so I think particularly if the IRS was aggressive, the Franchise Tax Board was aggressive before COVID. I think that will only probably increase as we go forward, because obviously, we're moving from a period where there were projected budget surpluses to, pretty substantial deficits, and it's a question of, okay, how are we going to fill that hole? So I would only expect that things get, the FTB gets kind of more aggressive, quote unquote, from this point forward.
I want to answer a couple questions that just came in. One is from Mark. Mark asks, is there a form that the FTB uses to conduct residency audits or that the taxpayer can fill out and submit?
No, I mean, there's not really a form per se. What happens in most audits is that an auditor from the Franchise Tax Board or an examining agent will send out, one or more they're called IDRs, information document requests. And it's a letter, it's in the format of a letter, and it says, dear so-and-so taxpayer, I've been assigned to, conduct a, residency audit of your situation. Please provide me with the following information. And then there will be, a list, and sometimes it's like a laundry list of information that the examining agent thinks is relevant to a determination of, that taxpayer's residency. And oftentimes it's, multiple IDRs. And so, there may be an IDR 1, taxpayer supplies a response to it, and as time goes by, there could be 2, 3, 4, 5, 6, 7, 8 IDRs, and all just kind of digging into, that taxpayer's life. So there's not really a form, but I mean, there is there's a process.
Okay. Thanks, David. So another question from Linda. My CPA warned me that I need to check the state I want to move to see if my home sale here will also be taxed in my new state. How do I find out this information?
Yeah, so I mean, I guess there's sort of two potential things there. I mean, the first is, and this is, it's actually probably kind of more a question that I would actually direct to a CPA, okay, than for a taxpayer to find out, because it's kind of complicated. But certain states have tax credits essentially that they provide against income that would otherwise be double taxed. So if the sale of a home in California is going to be taxed in California because the income is sourced to California. So regardless of whether you're a resident, the sale is taxable in California. Whether that is also taxed in some other state, that would really depend on kind of whether that state offers a kind of a credit to offset that double tax. And that's a very state by state thing because California, for example, does have a credit for kind of this for double taxed income, but there's a lot of rules around it. It doesn't apply to certain states, doesn't apply in certain situations, and so it's hard to give kind of a blanket answer there.
Okay. So really the answer is to talk to your CPA. They may have to do some research on the state that you're moving to be able to get you the right answer.
Yeah, I think that's right.
Okay.
Yep.
A couple more questions, but before we get to that, let's talk more about what are some of the red flags that you're seeing, and how can that, well, I guess we'll find out how could that possibly be avoided, but what are some of the red flags, the most common scenarios where somebody's getting an audit that you're seeing?
Yeah, so I think I think really, and I think I sort of mentioned this before, or touched on it at least, but most residency audits, I think in my experience, stem from some sort of inadvertent information that was provided to the franchise tax board that kind of piqued their interest. So, like I said, this could be the IRS forwarding a return to the franchise tax board because it has a California address on it. It could be, let's say a taxpayer, has a vacation home here in California, and they have a mortgage on the home, and so they get a 1098 each year for the mortgage interest on the home. Usually, by default, that mortgage lender or the loan servicer will use that address, the home address, the vacation home address, as the location to which they send the 1099, and then as a result, that's how it kind of gets reported to the state. Yeah. So you may have a third party. It could be a bank, it could be a brokerage firm, or a mortgage servicer, whoever it is, that is reporting something to the franchise tax board, with that taxpayer's social security number and a California address. Those sort of things will, I think oftentimes can trigger an FTB, a residency audit. The other thing, which I think I've also touched on a little, is that, if there's a significant income event shortly after leaving California, that may be viewed with some, interest, maybe even suspicion by the state. And, I think those are the things that, I guess, the sort of red flags. And that's part of what, I do in kind of advising clients on residency matters is we go through kind of a checklist of different things. And one of the things that we look at is, just kind of what I was talking about in terms of information reporting, making sure that there's not some, information document like a 1099 or a W-2 that has a California address on it that's going to get sent to the franchise tax board, because that's kind of it's sort of low-hanging fruit, right? I mean, it's easy enough to contact your bank and say, hey, update my address for any correspondence and tax documents. It's easy enough to do that for a mortgage servicer or whoever. So it's kind of an easy way, it's an easy way to avoid that sort of potential trap, I guess.
Okay, awesome. Yeah. I want to get to a couple of questions here. We've got quite a few questions coming in, and then we'll kind of get back to that again. Nancy asks, if you sell your home in California and then move to another state with no income tax, and you purchase a home of similar value, does the franchise tax board have any right to any percentage of the proceeds from the sale of the home?
Well, yeah. So this gets to a kind of related topic, which is the sourcing of income, and different types of income are sourced in different ways. And without getting too deep in the weeds, I think it's easy enough to say that real property, and this isn't just true of California, it's basically true of any state, but real property is sourced to the state where the real property is located. So if you sell a home in California, that sale is considered to generate California source income, which is taxable in California, regardless of whether you're a resident here or not. So if you were to sell a home in California and move, somewhere else, or you'd already moved somewhere else and you sell a home here, that sale is still going to be California sourced income, and it's going to have to be reported to California.
Sure.
And I think that's just kind of baked in. I mean, obviously there's an exclusion, partial exclusion of gain from the sale of a home.
121.
And that may have some effect of ameliorating or lessening that burden. But yeah, that's kind of the way that works. But it's an important thing to keep in mind, because in a situation like that, you're going to be filing a non-resident return with California to report the gain on the sale of that home, because that income is sourced to California. So now you're providing a tax return to California, and part of that tax return includes it's a schedule where basically you show, here's what I reported for federal purposes. Here's the adjustments that I'm making for what is taxable and not taxable in California, and here's the final amount that's taxable in California. And if there's a significant delta, a significant difference between what you reported for federal purposes and what you're saying is sourced or taxable in California, that again could be one of those things that raises the interest of the FTB. Where I had $10 million of federal income, but I only have, $100,000 of California sourced income. Well, it may be worth, given those dollar amounts, somebody looking into that a little further and seeing, well, is this really right? Because there's a lot of, tax dollars at stake here.
Another question that's related to this from Mark. Mark asks, is rent of property in California also always taxed by California, such as like the proceeds of a sale of a property?
Yeah, so it's the same thing. So rents are going to be sourced to California. Yeah.
Okay. Donald asks, if I move to a state in a temporary residence while my final home in that same state is being built, would this raise a red flag with the FTB, especially during the time I am in the temporary residence?
Yeah, it's a good question. And I think that kind of goes to what a point I made a little earlier about, once you have established a domicile somewhere, you basically are considered to keep that domicile until you've clearly established a new domicile. So, in that situation, it could be that the FTB takes the position or is of the opinion that, the temporary residence, being in the temporary residence does not clearly establish an intention to change your domicile. But, that's one factor that the FTB is going to look at. And to be honest, there's a list of, it's about 18 to 19 factors, and it's not even considered an exhaustive list of factors that the FTB will look at to establish in its view whether it thinks you're a resident or not for tax purposes.
Let's do one more question. By the way, I appreciate these questions. I think that everybody can get a lot of value in the questions and the answers that we're getting. So Greg asks, we moved to Tucson permanently April 1st of this year. We've been working remotely here at our jobs based in San Francisco. We have a home here, no home in California, have registered our vehicle and registered to vote in Arizona. We are using a Bay Area credit union, however. Are any of these red flags for an audit?
Yeah, so I do think, well, maybe the way to address that is to talk about kind of what the factors are that the FTB looks at. So like I said, there's a list of 18 or 19 factors. They're kind of commonly or colloquially known as brag factors from a particular Board of Equalization case that they came from. But, they look at things like, residential real property, where you own residential real property and the approximate sizes and values of those residences, the state where the taxpayer and their spouse and children reside, the state where children attend school, the state where you claim a homeowner's property tax exemption, your telephone records, the origination point for telephone calls. And some of these things are sort of anachronistic at this point because we all have cell phones. And so, what value is there in your telephone records? Maybe not a lot. If it shows a bunch of calls from a California zip code, but it's a Hey, Scott, can you still hear me? I think I may have cut out there for a minute.
I can. You cut out for just a minute there, but we've got a still screen of you, but we're still getting most of the audio. Okay, great. Well, hopefully the video comes back as well. I was talking about the telephone. Other things that the FTB is going to look at. It's going to include, your days in California versus your days in other states. The purpose for why you're here, both federal and state, where you claim to be a resident on your tax return, where you have bank and savings accounts, where your checking and credit card transactions originate from. So if I'm swiping my credit card in California all the time, that may be an indication that I'm physically present in California a lot of the time. Where a taxpayer maintains, social, religious, think, professional societies, think clubs, where you register your cars, where you have a driver's license, where you're registered to vote, where you obtain professional services, where's your doctor, where's your dentist, where's your accountant, where's your lawyer, where are you employed, where do you have business interests, where do you hold professional licenses? I'm an attorney, I'm licensed to practice in the state of California. That may be an indication of where I'm a resident. Where you own investment property, if you have rental properties, if you have commercial properties. Those are the sort of factors that the FTB is going to commonly look at. And no one of those, and the tricky thing, I think the complicated thing is that none of those factors is controlling. There's nothing that's determinative. There's no bright line test. And all those factors are of comparative value to each other. And what I mean by that is that, the place where, you work, or that your children are, is not necessarily more or less important than, where your dentist is, or, where your, what does, the area code is on your phone number, which I think really can be difficult, because some of those things I think clearly are of greater value or should be of greater value, but that's not really the way that the FTB analyzes it. Got it. Those are some great examples, David. And I've got another one that kind of relates to that. Another question here from Matthew. Matthew asks, relocating to Nevada, wife will continue to work remotely for a California-based company. Is her income taxable in California? I think that's hard to say without knowing more facts. It may be just because they're continuing to work in California. It's going to depend on kind of those other factors that I think that we just kind of talked about as well. And I would think that also a very sharp CPA should be able to answer some of those questions, right? As far as how they're going to file, what that scenario looks like. Yeah, absolutely. And part of it, I think, is, I want to say that, taxpayers should be mindful and, diligent about telling their CPA or their tax preparer that this is what I am doing. Yeah. So that there is no sort of inadvertent thing. Like I mentioned the
I mentioned the client that I had where, they inadvertently continued to use a California address on a return. And that was purely because basically the way that the software is set up that the accountants use to prepare the tax return, it just kind of rolls over that information from year to year because it assumes it basically stays the same unless the preparer, the accountant, updates it.
Mm-hmm.
So, because the taxpayer never kind of told the accountant, or they may have had a discussion about it and it just, for whatever reason, it got left on the return with a California address, that can have an unintended consequence. But it's important for, I think, taxpayers to have that conversation with their accountant, with their preparer, and say, this is what I am planning on doing, and really making sure that that's not just, not an afterthought in a conversation, or as you're walking out the door, but is done with some sort of real intention.
So we've got a few other questions that I will get to, but the key word that I heard from you, David, is planning. So we're talking about, and I'm sure that a lot of the folks on the broadcast today are in the planning stages, wanting to do it the right way, not to miss anything, and to make sure that they're not leaving themselves open to any potential issues. Mm-hmm. As far as residency planning, how far in advance do you suggest people start with, if having a conversation with you makes sense to do, how far in advance should they do that prior to the execution of their plan to move?
Mm-hmm. No, I think that's a great question. I guess I would say you want to try to start planning as far in advance as possible. And that, to me, that means multiple tax periods. That means, ideally that's years in advance, but obviously that's not, a realistic possibility in most situations. And that's kind of a standard answer. I think you find a lot of times, with tax attorneys in terms of planning is, it would be great if there was at least 2 years, in advance, but, usually that's, more often than not, that is not the case. But I think important to keep in mind is that it's not just about how many years in advance you start the planning. It's also about, really analyzing what connections you're leaving behind in California. So the planning can also be useful for people who have already physically left California, but are worried that because of their kind of continuing ties to California, or their intermittent physical presence in California, that they may be classified as a resident in the event of an FTB, of a residency audit.
Sure.
So it kind of works. There's potential for it to be advantageous both to people who are looking to move out of the state and also people who have already relocated but have those kind of continuing ties to California.
Okay, awesome. Another question here. If a fiduciary of an estate lives in California, is the income of the trust taxed in California if the beneficiary doesn't live in California?
Yeah, that's a good question. California has its own fairly complicated set of rules for how trusts and estates are taxed, and it's kind of a multi-pronged thing. It depends on the kind of the location of beneficiaries and the location of fiduciaries, and to be honest, I know enough to know that when I get a question like that, I need to talk to one of my estate planners about that, because that's really what they specialize in.
Absolutely. Edward asks, does the COVID work at home requirement allow new latitude for an employee who establishes a domicile outside California to maintain a California employment, but be domiciled elsewhere?
Yeah, it's an interesting question, and unfortunately, I'm not familiar with the COVID rule that the questioner is referring to there.
Okay.
Yeah.
Let's do one more here. Greg asks, if I rent my home in California, assuming a home he owns, while buying a property in another state as my new primary residence, would it be possible to do a 1031 exchange with the California residence for a rental property in the new state?
Yeah, well, so I guess I'm not sure I got all the facts on that exactly, but I mean, as a basic premise, if you have a personal residence and you are going to convert it to a rental, you can do a 1031 exchange on that. There's kind of a revenue procedure and almost sort of a safe harbor that you have to meet in terms of how long you have to rent it for before you can do an exchange.
Sure.
But and I may have been missing something in the facts there, but once you do an exchange, you have a certain amount of time after you've sold your relinquished property to acquire a replacement property, so that the timing may not sync up there. In other words, if you have a home that, let's say, home in California, you're going to convert it to a rental today. You're moving out of state, you're buying another home somewhere else. Your sort of replacement property in that scenario is the home out of state. You're acquiring it today, but you need to rent the home in California for 2 years before, minimum of 2 years before you can do an exchange. So there may be a timing issue there, or it might be that I was misunderstanding the facts there a little bit.
Yeah, and that might be two separate events, right? You're purchasing a primary residence somewhere else, then you convert your primary residence in California to, you meet the guidelines for that being an investment property, then you transact to purchasing a new rental property in the other states. So that might be two different situations there. Okay, let's see here. If I move first, but sell my house second, is that an issue? And that's from Denise.
Yeah. So, I mean, is it an issue? I guess it's a factor that the FTB is going to look at, right? Because you continue to have a residence in California. I think whether it's an issue, I mean, in part, it's going to depend on all the other factors too. But one of the things I would say, I guess, on that sort of issue specifically is it depends what you do with the home that's in California. Is the home sitting vacant? And therefore you, in theory, could come back and, make it a residence again? Or is it rented to somebody else? If it's rented to somebody else, then it looks like its use has been converted from personal use to, an investment property or a rental property. And so it may change from being a potential residence to being a rental property.
Yeah, I think so. Denise just responded. Her plan is to sell it as soon as possible, so it wouldn't be a long-term hold rental property.
Yeah. So in that case, I don't think that the mere fact that you would continue to have a personal residence in California would be determinative of your classification for residency purposes. It's gonna depend, like I said, on all those other factors as well. So it's just sort of it's kind of everything else, the facts and circumstances surrounding it.
Yeah. Okay. Let's talk about what should you do if you find out you're being audited by the FTB? What's the first step?
Yeah. So, I mean, I think, and I'm gonna say I'm gonna confine this answer to sort of what we're talking about, which is a residency audit, right? Because if you get a notice in the mail that you're being audited for your business or something else, I think what you do is not necessarily the same as what you would do here.
Got it.
But if you're, if you find out that you're the subject of a residency audit, I think it's, and I think you are concerned about your connections to California, then I think it behooves you to, have someone represent you sooner rather than later in that process. Because I think, we're all sort of familiar with the expression that, you only get one shot to make your first impression.
Yeah.
And I think that's true of a residency audit as well. In the sense that, if you are, you want to make sure that you are, presenting things in the right way, and that you are, your story is the right story the first time around. I mean, I could tell you probably several different instances of, clients that I've had where they may have represented themselves or an accountant or somebody else represented them before. and we find ourselves sort of constrained by things that were said or done by prior representatives.
It's almost like you're having to backtrack, right? Because how do we dig ourselves out of this hole?
Exactly.
They didn't talk to the right person the first time.
Yeah, exactly. And I mean, there's you know, there are times when you know, if you answer the FTB's question kind of, you know, early on, it may end the audit. You know, there may be one thing in particular that the FTB that triggered the audit and the FTB wants to know about. And it may be a matter of, you know, if that is, you know, addressed, the audit may go away. It may not proceed any further. But, you know, I think where people sometimes can run into trouble, and I've seen this in representing clients, is that I think sometimes, in part because of how personal sometimes the information is that the FTB is requesting, people will, you know, kind of get a little defensive about it and say, you know, well, I'm not providing that to you, or why should I do that? No, I'm not giving you that information. Mm-hmm. And that, you know, I think that's a natural reaction. The thing is, though, that kind of taking that adversarial stance with the FTB it often is not to a taxpayer's advantage, because, you know, one, I think it can make an auditor kind of more interested in your case than they otherwise would have been, because if you know, if a taxpayer is sort of very reluctant to provide certain documentation or support that's being requested, you know, the auditor may be wondering, well, why don't you want me to see that? What's there that you don't want me to see?
Yeah, absolutely.
So
we've got, I want to answer a couple more questions here. Probably need to wrap this up in about 10 minutes. We'll do 2 questions. I want to get back to you, David, just to kind of find out what we haven't talked about that people need to know, and then we can wrap it up with any additional questions. Edward asks, is there a comprehensive checklist of what is required to establish domicile outside California that is likely to survive a residency audit?
I don't know that there's a comprehensive checklist. I mean, there's those factors that we talked about, those brag factors, but it's all a comparative analysis. So, you know, I mean, I think that the unfortunate thing with California in terms of its residency rules is that there's only one bright line test in California for residency, and it's a presumption essentially that if you spend more than 9 months here, that you're presumed to be a resident, and it's a rebuttable presumption. But it only works in the FTB's favor, because if you're here for less than that, there's no presumption of non-residency. So it is really, you know, if there was a checklist or, you know, a sort of a set of requirements that you could meet, I think, you know, the FTB would have a lot harder time, because everybody would just structure their lives to fit into that perfectly. But it's a facts and circumstances analysis.
Another question somewhat related to that comes from Mark. Is the way that one would learn that they are the subject of a residency audit that they receive an information documentation request from the FTB?
Yeah, I mean, that's probably not going to be the first step. It may be. I mean, oftentimes it'll be first you know, a letter from the examining agent saying, you know, you've been selected for exam, or I have some questions about, you know, A, B, or C. And then it may also include a you know, an IDR as part of that. So it could be it could be a letter first, just sort of saying you've been selected, or I have a question about something, or it could also include the IDR.
So David, what have we not covered that people need to know? Any gotchas, any additional information that you want to put out there?
Yeah, so I think, you know, one thing that we haven't talked about so far, and this kind of dovetails onto what we were talking about just a little while ago in terms of, you know, getting somebody to represent you who's kind of competent in this area, is that, you know, there are other avenues that are, you know, available to taxpayers who have, you know, who may have a residency issue. And for example, the one that comes to mind is FTB settlement. So the Franchise Tax Board has this sort of parallel parallel avenue for resolving tax disputes that is called the settlement unit. And basically where, where at audit or protest, it's kind of all or nothing. You either win or you lose. Settlement is, a settlement officer has the discretion and authority to settle a case for some fraction of the balance due. And so for some taxpayers, I think, that I've represented where their facts are not particularly strong, we've advised them that, look, you can continue to go to protest or appeals, but you also have this parallel opportunity to go to settlement. And if we can settle your case for, instead of 100% of the tax liability, whatever that is, if we can get a concession of, 20% or 30% or 40%, that may be an attractive option, especially if you don't have a particularly strong set of facts. But it takes somebody who is familiar with going to settlement and kind of how it works to, advise a client about that, because it is kind of a parallel track that, unless an auditor or a protest officer brings it up, somebody might not otherwise know about. So that's one thing. I think, the other thing that we sort of, in terms of kind of gotchas and advice that it sort of touched on before is that, I think taxpayers can kind of do themselves more harm than good by sometimes being overly adversarial with the Franchise Tax Board, because the Franchise Tax Board has the authority to impose a penalty. It's called the failure to furnish penalty. And so, if the FTB, for example, asks for bank and credit card statements and, a taxpayer refuses to provide them, the FTB can impose a 25% penalty on top of whatever the tax was for the failure to furnish this information to the Franchise Tax Board. And so I've seen that happen. And once that failure to furnish penalty is imposed, it's very hard to get it withdrawn. And it's just, it can, you're compounding the liability at that point. And, I think it's something to keep in mind that a lot of taxpayers aren't familiar with.
And that's a significant penalty, right? I mean, you just don't want to risk it. It's not going to go away.
Yeah, absolutely. And I mean, some penalties are, they're kind of fault-based, and if you can show reasonable cause, you may be able to get out of them. That failure to furnish penalty is, I would say, one of the harder ones to get out of.
Okay. So, David, is it fair to say that some people may need your services, some may not? Mm-hmm. How do people, I mean, how do you determine initially, if you're having a conversation, what does that look like to find out, yes, you may need our services in residency planning, or no, your situation's pretty cut and dry. You don't need our services, at least at this point?
Yeah, I think, what I do with clients in that sort of situation, or potential clients, is I want to kind of ask them about, okay, what is your situation? Tell me about kind of, what's your life like now? What are your plans? Because, and maybe it's easier to give an example. So let's say you have a person who's, lived in California for a long time. They're retired, and they're going to move to, Florida, let's say, and they sell their home here, or their plan is to sell their home here. They're going to move, they're going to, buy a condo in Florida, and that's sort of it. That they don't plan to come back. Maybe their children have already moved away, or, they otherwise don't really have any reasons to come back to California. And they're just going to kind of live out their retirement years. There's no, big sale of any stock or company in their future. I think that's a relatively low risk situation. And I would say that's a pretty clear case where, you probably don't need any sort of planning for that situation. By contrast, if a taxpayer is going to be moving out of state, but they're going to continue to have substantial ties to California, family here, business interests here, real property here, then those may be the sort of things that, require more attention or thought or consideration of. And especially, it's a matter of, I think in part, what is the amount of income that's at issue? Somebody who's, routinely making, substantial, reporting substantial amounts of income on their return is probably going to be of more interest than, somebody who is making comparatively less income. So, that's part of it too, that if you're talking about somebody with substantial assets or substantial income, that's going to be of greater interest to the FTB.
Okay. I want to remind everybody that this is being recorded. So if you got on the broadcast late, you can request a copy for yourself or for somebody else who you want to forward it over to, who you think would benefit from this broadcast. info@leavingthebayarea.com, info@leavingthebayarea.com. David, if somebody wanted to get in contact with you, what's the best way for them to do that? And after you give that, I've got 2 more questions that I want to make sure we answer before we close out.
Sure. So I think the best way to get in contact with me is through my email. It's David .Bellumori. It's B as in boy, ELLU, M as in Mary, ORI, at Berliner, BERLINER.com.
And if for some reason, if you're listening to this through your phone, or if you're not able to take that down, you can always contact us again at the info@leavingthebayarea.com. We can certainly send you over David's contact information. Brad asks, I will make a transition to a new state at the end of 2021 and could do it on December 31st since I already own the new property. Makes records easy for me to do it exactly at year end. Any reason not to do it that way?
No, I mean, I guess if anything, it would be maybe advantageous to do it sooner than that. But I don't think there's anything necessarily wrong with doing it then. I mean, I think the one thing that, I guess in my experience, sometimes I think the FTB kind of raises a little more of an eyebrow is when somebody goes from being a resident or a full year resident to the next year being a non-resident. And I think it's a little bit smoother of a transition where somebody goes from resident to part year resident to non-resident. But if you're leaving if you're really leaving on December 31 at the end of the year, maybe there is no part year return. It's just in my experience that sort of that progression from resident to part year to non-resident seems to be a little more kind of fluid or a little more intuitive.
Thomas is asking in relation to the 1031 exchange, if I do a 1031 exchange of a California rental for a like-kind property in Nevada and eventually take it as my primary residence, is there going to be any risk with California or requirements with California?
Well, yeah. So I mean, the one thing I think you want to keep in mind there is that, and this applies to kind of anytime you're doing an exchange out of California into property in another state, which is that so California has a particular form, and I can't recall the form number off the top of my head. But for purposes of an exchange where you are exchanging out of California real property and into real property in another state, California respects the deferral of that income. In other words, California respects that you did an exchange. The problem is that, or the issue for taxpayers is that California takes the view that a portion of that, deferred gain that is built into your replacement property is still has a California source because it relates to the property that was in California. And so there's an annual reporting requirement that you have to give to the FTB to kind of report that, that exchange. And once you dispose of that property subsequently, California will be looking for its portion of the tax from that sale, or from that subsequent sale.
Okay, perfect. David, you've been a wealth of knowledge. I mean, this is really incredible. So thank you so much for spending the time with us, and thanks to everybody on the broadcast for spending what's been just a little bit over an hour. Again, if you have any questions for David, he provided his contact information if you weren't able to get that down. You can always email us at info@leavingthebayarea.com. David, thank you again. Fantastic content, fantastic information. And yeah, kudos.
Scott, happy to be here, and great to talk to you and everybody on here. So,
all right, fantastic. Everybody take care. We'll see you next time. Bye for now.
All right. Thanks.